Okay, thanks for joining. Today we're kicking off our second quarter reporting, and we're going to go through commercial and industrial assets. We're going to give a little bit of overview of what we're seeing nationally going on, or kind of the macro level trend, and then what specifically we're doing in our portfolio. Overall, too, we have our property-specific reports. Those all go out today on the 20th as well. And then we're going to have a Q&A live stream on the 31st, which is Monday in a week and a half here. So going through that, and that we can dig into really any specifics there as well. But we want to give an overview of what we're currently seeing right now in the marketplace.
Yeah, so if we open up with, a lot of the headlines are about really the demise of commercial office space. And, from our exposure and experiences, we're mostly in suburban Atlanta, mostly in kind of the Class C space. So, if you look at the national headlines, the Class C space the availability is up about 2.5% from a year ago. It's really, the headlines are really hitting on the really trophy assets, A and B space, which availability is up 5 to 9% year over year.
Yeah, A and B space is really getting hit the hardest right now. And that's in mostly multi-story buildings.
Right, like really those traditional downtown high-rises that people commute into and go to, that's where you've seen the biggest really decline in occupancy.
Yeah. And we don't own any trophy real estate assets. That would be nice at some point, but those seem to be doing better than most other
than A and B.
Assets. Yeah,
right.
I mean, they're better than A and B, but they obviously still have some challenges. But nationally wise, kind of the best and highest and most expensive is holding in there, and then Class C is working. Class C, it's almost affordable. Is more just there's so many different opportunities of what you could put in that space.
Yeah, affordability, accessibility, convenience, lack of commute, all those reasons why kind of the suburban Class C stuff is working.
Yeah. When we think about Atlanta specifically, Atlanta still has about 3 million square feet of office that's coming online in the next 12 months. So there's stuff that was under development, a while ago that's finally getting completed and coming on board. So, but that's also traditional office space that they're adding to it. And then on the same stance, just in our kind of like microcosm, we've talked about it a little bit on the affordable office side. Within, I'd say, like 3 miles of here, there's about 1 million square feet of office that's being torn down and rebuilt with apartments or townhomes, a little bit of mixed use, but it's, they're reusing that space. But you can do that in Class C, whereas the larger Class A or even multi-story buildings, it's so hard to tear that stuff down or repurpose it.
Right, they're also usually on such tight, dense lots that you can't really go low density anything. You have to go back with a high rise, which would really go to more of a refit.
Yeah. So we see some opportunities in that space. I think that's going to be very interesting. Of what do you do with a bigger building as you retrofit it, or do you tear it down and replace a skyscraper? I think anytime you drive around and you see the big cranes, like that looks really cool. That's not at all what we do, but it does look cool. I'm sure there's going to be some opportunity in how that side of the market plays out. For us, the opportunity we do see, and we'll touch base on our performance here, but finding these single-story office buildings and what can be done with them, that's more in our wheelhouse of execution ability as an owner-operator, but more reasonable price point basis and a lot more options that you can do with it.
Yeah, and part of the density of those single-story office buildings, not only are they really spread out because they're single-story, but also they generally have 4 to 6 parking spots per 1,000 square feet. So you have a ton of parking as well that you can work with.
Yeah, so we got a lot of room. So right now in our portfolio, one of the biggest things that we have been working on is our CAM reimbursement. So when we purchase deals over the past 2, 3, even 4 years, 5 years that we've been purchasing commercial space, CAM reimbursements are a big part of those lease structures. And that's typically around $2 to $3 a square foot that a tenant's also paying on top of their rent. And we have done a pretty good job maintaining our maintenance costs across our footprint. But the things that are out of our control, what we call non-controllable, are really taxes and insurance. And those things, we make appeals. We work our butt off to try and get the best insurance we can get. But those costs have still gone up. We noted that in our residential update. Insurance costs up basically double over the past 3 years, 30% this past year. So we're seeing big increases, and now we're working with our tenants as we're kind of passing a lot of that cost through. To the tune of things, it's a big number when you look at, hey, this is going to be an additional $2 to $3 per square foot. A lot of deals we bought, those tenants were not paying that stuff, but it was in their lease. So imagine you're a tenant, you signed a lease, you've been operating for a while with a previous owner, and they haven't been making you pay that stuff. Now we're coming in, and we are working to collect the CAM and fully go through the lease. That's a hard conversation a lot of times.
Yeah, that was a big part of our business plan and the value add story is that if a building was really collecting so much revenue, we were fine with buying the building at that current revenue. The value add was now collecting that CAM that was already built into the lease. The tenant already agreed upon doing it. They just hadn't been making that payment because the previous owner was not enforcing it.
And we look at the value add happening two ways in an asset. We have the physical value add, which is, I think, easier to visualize and see. And you have the operational value add, where you're going to go in and have these tough conversations with a tenant of, we're either going to pay more, we're going to go through what the lease terms look like. And maybe it is we're going to rewrite a lease. And that could be the case too. But that's all operational improvements that we're making with our management team. Right. Now, some of our office space too and our commercial space has vacancy. And that's where we're looking at the majority of what we have is single story. How do we convert that to a flex or a more open space? I toured a place this morning that we're looking at. It has a very nice vacant office in it. But the idea of clearing out that office, putting in nice roll-up doors in the back, having a really flexible environment that we could put anyone in, that stuff is leasing well. So overall, escalations, even what we're doing, because we are signing office leases right now. We've signed a good amount of office leases this quarter. We had our largest lease we signed was about 26,000 square feet that we signed, and we're negotiating two right now that are more on the medical side, but those are that's another one's 25,000 square feet and a 10,000 square foot office lease. So our occupancy is stable, and then we are seeing some gains, but those are much higher TI dollars. We're seeing 3 to 4% rental rate escalations. On the medical specific tenants, we're seeing, it's over $50 a square foot in TI improvements to build out medical. But a typical medical deal, it's hundreds of dollars a square foot to have a functional medical tenant.
Right. And coupled with that is we generally get a 7 to 10 year lease, maybe even longer sometimes. Yeah.
A flex space, if we're doing that and we're spending $3 in TI right. and we sign a 2-year lease or something, that's okay. Mm-hmm. You obviously can't do $50 with no real long-term commitment. But those leases are out there. The medical side, we're seeing activity in that space. We're seeing activity in the office space, especially for basically the most affordable levels. If you're able to sign a longer-term lease and get something really, right now, if you're the tenant side, it's probably good timing on price. So that we're seeing that activity right now. But our biggest thing really is the operational stuff of working through CAM and negotiating our leases with tenants. That's what we're seeing. And all of our quarterly reports, you'll see that in there of what the CAM levels were, common area maintenance reimbursements that are there. You'll see that on all of those reports so you get an idea of what we're doing on a deal-by-deal basis. So into industrial. Industrial overall nationally has been performing very well.
21% year-over-year rental growth. That's incredible.
Across the board, right?
Across the board, all industrial. Yeah. Atlanta alone, we're seeing flex rents in our area pushing just under $13 a square foot now. That's up almost 2x in the last 5 years. So it's pretty incredible growth.
We look at one of the last deals we bought here in Atlanta, Pleasantdale. It had the rents of $2 to $3 per square foot, all in. That was the rent, with market in that area at 13. So there's, obviously there's work that goes involved with that. That's just not a easy process, but there is a lot of value add opportunities in these flex spaces that are out there.
Right, and do a quick comparison for these flex deals. When we're talking about $13 a square foot, that's a triple net rent. Versus an office deal, you're generally getting, in our neighborhoods, we're seeing $17 to $18 a square foot, but that's a full service rent. So in that $17 to $18, we have to absorb, say, $6 to $8 of operating costs. So the net of that number is closer to 10. When flex, we're seeing 13, and we can pass all those operating costs through. So we're actually seeing
paying them directly,
or the tenant's paying directly. So we're seeing really a net $3 greater, net income number.
Yeah, it's pretty good. So there's other parts of Atlanta too where the rents are even higher.
Over in the full industrial corridor, they're seeing $17 triple net. It's incredible.
Yeah, so there's still lots of opportunity to buy flex stuff, and across the board, we're seeing nationally it's like 96% occupancy, right? Mm-hmm. These things are for the most part full. The tale of two different types here, right? When you look at these asset classes, and buildings under 100,000 square feet are basically 97%.
Yeah, they're the highest demand. What we're finding is, and we're seeing this in our portfolio as well, is that these smaller tenants, say 2,500 to 7,500 square feet, are just, they're the most interested in getting into the space. They're readily available and they can move fast.
Yeah, that helps a lot. Speed helps a lot. So.
Yeah.
On the debt side, industrial, I mean, commercial office debt is essentially zero. There's like no new originations happening there. So that turns off the liquidity in the market on the office side a lot. On the commercial side for industrial, debt is up, right? It's up about 200 basis points for what we're seeing right now. I don't know if that's nationally. That's more what we're seeing, right? And we're seeing cap rates that are up about 70 points.
Right. Yeah,
So
pricing is holding pretty firm on a national level.
Yeah. And a lot of that is like the top level stuff. Most of that is not coming down to we're buying a defunct building with $3 rents, right? So that's kind of, you take a lot of industrial assets are trading that are stable. So those are obviously trading at much higher cap rate or much lower cap rates and higher values than a non-stable asset that is out there. We look at our footprint specifically. We've signed a bunch of leases here recently, all the way up to our largest one being 40,000 square feet that we signed. We've got some 20,000 square foot leases we've signed, and the smaller sub 5,000 square foot spaces they move pretty darn quickly.
Yeah, for a portfolio that we've built over the last 3 years, and our industrial flex portfolio is about 600,000 square feet, and we bought it probably barely 60% occupied. We're leased across the board.
Yeah.
So
we've got a couple of spaces that are vacant because when we're buying new deals, we are looking for ones that are vacant that we can take from this single-story office footprint and convert it into flex. So essentially add to our flex vacancy and then lease that space out. We've done a good amount of that leasing. The smaller businesses that are, and again, it says smaller business, but they're not really small businesses. They're doing pretty darn good clip at using less than 10,000 square feet in a space. So we're very excited to have those tenants and the relationship with those people as they're moving in to these spaces. We're able to provide them a pretty custom idea of what they want, in their space. So right now we have about 80,000 square feet of stuff that we'll be able to. One is converting it out of office into flex, and then we've got really about three suites that are available across the board.
Right.
So it's pretty high occupancy. The vacancy we do have is all brand new. We're hoping to add some new vacancy here in the near term as we've got some deals that we're looking at that will add flex vacancy that we can go convert and lease out. So overall, things are performing very well on the flex side. The demand is exciting to see. There's a lot out there, and we've got good opportunities to still find deals. I mean, leverage is going to be lower, but there's opportunities out there to really take this office stuff and convert that to flex and move it forwards.
Yes.
So. All right, so that's our update on it's kind of a blend of commercial going into flex, right? That's really where we see the opportunity that we can capitalize on. There's going to be other stuff out there, but that's what we're focused on here out of Atlanta in and across the Southeast. We are going to have a live Q&A on the 31st, so keep an eye out for that. If there's other property-specific questions that you have, we can dig through that stuff. And next week, we are excited. We have our Camp Greenleaf. So this is a week-long event up in Gainesville, Georgia. We have a summer camp for 60 or 70 kids that'll be there.
Yeah, our Park Hill residents and our mobile home parks in the area will all come together, and we usually have 60, 70 children and their families come. A lot of the parents volunteer with us as well, and we do a week-long summer camp. It's a lot of fun.
Yeah, it's free for the kids. It's very exciting. I mean, if you want to volunteer and you want to be in the area, come by. We'll all be there. The Greenleaf shirts on. It's always a lot of fun to see everyone. Our whole team is there really for this week doing it. So we've got that next week, followed by the Q&A, and distributions go out today, which is always exciting. So thanks for watching, everyone. Let us know if you have any questions. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.